back to Taxes Made Simple. I'm your host, Carlton Dennis, and I'm so excited that you're here today. Today we're going to go over how to take a tax deduction step by step. I am so sorry that no one showed you how to take a tax deduction in high school, no one showed you how to take a deduction in college, and not even your parents showed you how to take a tax deduction. But guess what? Carlton's going to show you how to take a tax deduction today, and we're going to learn how to do it the right way. Let's get started. So before we go over how to take a deduction, I have to tell you guys about a story where I wasn't taking deductions and it almost cost me like all of the money I have in my life. So let's talk about this. I'm gonna take you guys back to Carlton Dennis in college. I was graduating from college as a football athlete. I was just starting my first online business, selling training programs, and I moved to Hollywood, California. When I moved to Hollywood, California, I moved into an apartment with other roommates and I started helping other people get into the best shapes of their life.
Oh, really?
I was taking on income in the form of Venmo, in the form of cash, in the form of, hey, just go to my PayPal. And guess what Carlton didn't do? He didn't plan for the taxes he was going to have to pay, nor did he keep receipts for any of the things that he was doing.
Look what you did.
So when it came time for me to go into my CPA's office to figure out what type of tax deductions I could take before I became a tax accountant, I realized I had very little deductions to show for. And I do not want you guys to be in a position like this, whether you're a business owner or you're a W-2 employee. So today we're gonna go over 5 ways in which we can take a deduction, whether we're self-employed or whether we're working for the man. Let's get started. The student loan interest deduction. Now, this is only for people who have student loans, and it's only a deduction on the interest. So be mindful that you are not getting a deduction for paying into student loans. The government does not give a deduction for going to college, guys.
Why would you say that? Why would you say that?
But they do give a deduction on the interest for taking on a loan because you're working with the banks and the government loves the banks. So the student loan interest deduction is a max $2,500 that you get to take on your tax return. But be mindful, before you go and take this deduction, realize that there is a threshold based on how much money you make.
Damn!
Which means if you make too much money, you may not even be able to take the student loan interest deduction. And it starts to phase out the more and more money you make until it's all the way dwindled down to zero. So make sure you speak with your tax provider if you are paying student loans. Number 2, we have to understand the deductions that are automatically given to us now that we understand who has to file the tax return. So let's go over the freebies. The freebie deduction that we're given is the standard deduction. So if you guys haven't been told or haven't been taught what the standard deduction is, it's pretty much a deduction that's given to you as soon as you qualify to file a tax return. And now that we figured out who qualifies to file a tax return, how much is the standard deduction? Well, it's all dependent on how you choose to file your tax returns. You see, I filed my tax returns as a single individual for most of my life until I recently got married. And as a single individual in the year of 2020, the standard deduction is $12,400.
Oh, hell yeah.
Which means I automatically get a $12,400 deduction just for working and making over $12,400. So that is my one freebie I get by the government. But now that I'm married, the government doubles my standard deduction since I'm filing with my wife. So it goes from $12,400 in the year of 2020 to $24,800, doubling my standard deduction, and now me and my wife get to take double the benefits. But these aren't the only freebie deductions we're given. If I were to file head of household, which means I am single and I have someone who qualifies to be on the tax return as a dependent, rather than taking the standard deduction of a single filer, which is only $12,400, I get to take a little bit more since I'm supporting someone. The standard deduction for a head of household is $18,650. It's not quite the amount of the standard deduction for a married filer, and it's definitely not as low as a single filer, but it's still the freebie that you get when you're supporting someone that qualifies to be on the tax return. The other freebie that we get when we are filing tax returns is the itemized deduction. But we have to realize that unless we have items that exceed the standard, we're not going to itemize our deductions. So in order to take this additional freebie, we have to figure out what are our itemized deductions. Let's break them down. Itemized deduction number one, your mortgage interest. Guys, this only applies for people who have a house. So which means if you don't own a home, talking about itemized deductions may not really serve you.
If you're homeless, just buy a house.
However, there are some itemized deductions that could still work in your favor. Outside of taking mortgage interest and property taxes, you might be paying into state taxes. Maybe you're in a state that taxes, and maybe you're paying a lot of state tax based on the amount of money you make. The IRS allows for you to deduct up to $10,000 in state taxes as an itemized deduction. Now, that's still not more than the standard deduction, so let's figure out what other itemized deductions we need to know. The medical and dental expense deduction. This is the next itemized deduction we need to be aware of. The medical and dental expense deduction states that if we have medical and dental expenses that exceed 7.5% of our AGI, that we can deduct them on our tax returns. But what you have to understand as a taxpayer is what is 7.5% of AGI, and what does that even mean? So you first have to learn how to calculate your adjusted gross income. You can find this number on your tax return if you look at your tax return from last year. Your adjusted gross income is going to reflect how much you are able to actually take in a deduction based on the medical and dental expenses you have. So if we have an adjusted gross income of $100,000, the only way you're going to ever be able to take medical and dental expenses is if you have medical and dental expenses that exceed $7,500. 7.5% of $100,000. Guys, simple math. And taxes really shouldn't be that hard to understand.
I don't understand. I don't understand.
Now that we've gone through two of our itemized deductions, medical and dental expenses, as well as mortgage interest, we're going to go back over property taxes and state taxes. Property taxes and state taxes is called SALT, state and local tax. We are only limited to $10,000, which means that if I have a property that I'm paying property taxes on, but I'm also paying state taxes as working as an employee, I'm only able to write off $10,000 in combination with these two amounts. So I gotta be very mindful of choosing standard deduction or the itemized deduction based on these limitations by the government. Last but not least of the itemized deductions is charitable contributions. Guys, most of us are pretty philanthropic these days, but we wanna make sure we're tracking our philanthropic activities. And if you're tracking your philanthropic activities, you're able to deduct those philanthropic activities on your tax return as a charitable contribution. Keep in mind though, you just went through all of the itemized deductions with me. Medical and dental expenses, mortgage interest, property taxes, which includes our state taxes, and charitable contributions. So if we do not have more than the standard deduction that is already given to us, unfortunately the itemized deductions just don't matter. And you might be a taxpayer who has a home, pays mortgage interest and property taxes, but the standard deduction could still be bigger than what you're paying into property taxes and mortgage interest. So just understand this as you're continuing to build wealth. Number 3, in order to take a deduction, we have to understand the deductions that are not given to us. Let's go over those. Unreimbursed employee business expenses. This one is like a dagger to the heart. And part of the reason why is because Carlton works with a lot of teachers, he works with a lot of firefighters, and a lot of employees that pay for their own materials. If you're a teacher, chances are you might pay for your own whiteboard, your own crayons, your own Crayolas for your classroom. And if you're a police officer, you might be purchasing your own guns, boots, and equipment. Additionally, a lot of my taxpayers are working from home right now, which means that they're purchasing a lot of laptops, computers, things of that nature to make life at home a lot easier. But one of the downsides to being a W-2 employee is that all of these different items that you might be purchasing just to be better at your W-2 job, you're not able to deduct them any longer on your tax return. As a part of the Tax Cuts Jobs Act of 2018, the Trump administration implemented new laws that got rid of unreimbursed employee business expenses. So if you're an employee that used to get reimbursed in the form of taking that deduction on your tax return for paying for your own materials, you no longer get that deduction anymore.
What, are you kidding me?
And if you're not being reimbursed by your employer, then you do not benefit for paying for supplies and business expenses that you do not get to deduct through the business of the company. So be very mindful before you spend money on supplies and materials that you speak with your tax accountant and that you understand a little bit more about unreimbursed employee business expenses. Number 4. How to take a deduction starts with having a real legitimate business. And I want you guys to understand, in order for you to truly reduce your tax bill, you are going to want to turn some of your personal expenses, the everyday items that you're already spending your money on, into business write-offs for yourself. But the only way we're able to do this, based on the rules by the government, is by having a business. You see, once you turn yourself into a business, in whatever form or fashion that may be, your items that are normally considered personal items, such as your laptop, your cell phone, or even eating out, can now be converted into business items.
Yeah, wow.
You are turning those everyday expenses that you put on your debit and credit card into business expenses that can reduce the amount of money that you're taxed on and may even allow for you to bring home more money on your paychecks.
Thank you, Jesus!
But in order for you to make sure that you're not in a position where you're getting in trouble with the IRS, you have to run a legitimate business. And here's the reason why. The IRS states that if your business is not profitable or if you're not showing an economic gain for 2 out of 3 years, they can subject your business to be viewed as a hobby. And anytime your business is viewed as a hobby, all of the expenses that may have been personal to you that you were converting over to business could be treated as personal expenses and they can get disallowed on your tax return. So if you took a write-off and filed your taxes and earned back a huge refund because you might have been at a loss, the government can come back, amend your tax returns, and you could end up owing. Plus, you'll pay penalties and interest fees. So the one thing that we have to do is we have to decide, are we gonna start a business? And if so, how are we gonna do it in the right way? Because the government is too smart for us to be able to take losses on our tax return and just benefit from being able to adjust our withholdings with our W-2 employer. So we wanna make sure that we're running a legitimate business. Last but not least, number 5, hiring a tax strategist and putting your tax strategy in play. A lot of my clients who are just getting started in business typically are operating at a loss. If you're working with a tax strategist, you can adjust your withholdings so you can take home more money knowing that your business is going to be at a loss in that first year. There's nothing wrong with doing this. However, what we want to do is we want to start strategizing to avoid the taxes associated with any business income you might be making as you look to take additional deductions. Part of the reason why I say any business income you might be making is because I'm encouraging you guys to start a business and to get out there so you can start taking additional deductions that most W-2 employees just can't take. Additionally, you can also look into rental real estate, which happens to be my favorite vehicle. I can talk all day about this, but what I'm encouraging you to do is go watch one of my other YouTube videos and let me know what you like. I will be creating more videos like this. And if you liked today's video, feel free to comment, like, subscribe, and I look forward to seeing you on the next one. Take care.